Praise be Jesus. Thank you, everyone, for joining us today. Apologies for some technical glitches there as we try to work through this with the studio. So happy to have you with us for this month. Tremendous amount of news flow since we were gathered together last month that we want to share with you. We're going to focus this presentation today around gold, silver, and Wall Street's blind spot. I want to say to you first, we're going to delve into the finance here in a moment, but we have a bunch of people coming in just from finance. We title this God in Gold. Wall Street says that you have to keep God out of finance. Scripture suggests he wants to be involved in our decisions. And I submit to you, the first three words we say, praise be Jesus, will lead to greater wisdom in the decisions you make. You don't believe me. Many of you are here for the first time. Well, what we're going to highlight for you is two diametrically opposed views of what the future looks like right now. We have Goldman Sachs with their multi-billion-dollar franchise, Bank of America. We have Wells Fargo. We have Merrill Lynch. We have Morgan Stanley, JP Morgan. We're going to show you how they have allocated their client assets and how they have expressed with their clients' money that they don't believe it is prudent or timely to have physical gold. Either they're right and history no longer matters, or history still matters. And what we're going to show you is that Wall Street has never gotten its clients out of an asset bubble before it burst. So we're going to delve into that now. We hope this is going to be very informative to you as well as educational, and underscore why you want some gold. We are not talking Armageddon. We are simply talking about recognizing there is a debt crisis that's coming right at us. You want to know what has helped families protect themselves from these in past bubbles as they burst. All right, so moving forward here, thank you to the studio. If we can head to our first slide to share with the audience. We want to remind you of a recent quote that we had spoken about on our prior presentation. And it was spoken by the Chief Investment Officer of Bank of America, Merrill Lynch. Millions and millions of clients. And their CIO said, clients want to own anything but bonds. And we'll delve into why he said that. And he is right, in our opinion. But look at what the street reveals with its filings. Now, these are estimates. The actual numbers currently are slightly different. But what you see on the left-hand axis, the y-axis, are some of America's largest investment managers where individuals, families across the country keep their money. Morgan Stanley has $9 trillion of American families' money. $3 trillion of that money is in bonds, approximately. You see JP Morgan has trillions of dollars of bonds. Bank of America, Merrill Lynch, over $1 trillion of bonds. So there are massive amounts of client investments held at these firms that are positions in complete juxtaposition from what their strategists are saying should be done. So moving forward, what you'll see too here is another way of thinking about this. This is JP Morgan's 2026 asset allocation survey. Again, these are estimates. And if you look at the AAII survey, the American Independent Investor Survey, the numbers are going to be slightly different. But here you get a sense, equities, which are both public stocks and private equity, are almost 50% of allocations across the board. Fixed income, which are the bonds that we were just talking about that no one should own, and what's called private credit that we've spoken about before, that months ago we were saying this was a sign the drawbridge is going up. It was so reminiscent of the issues at Lehman Brothers where everyone downplayed it and said nothing else is going to happen. Don't worry. Don't be a doomsayer. Private credit with bonds, public bonds, is almost 35% of client assets. Now, notice there's not a slice for gold. They don't even have physical gold in their surveys. And part of that reason why they don't is that their clients don't own it. We mentioned before Ray Dalio, who ran the world's largest hedge fund, said as of the end of last year, if you looked at the accounts run by investment advisory firms, their clients' wealth, less than 1% was in gold, less than 1%. So it's not even a rounding error, really, in these asset classes. Moving forward, we want to look at now this study that we have done about what has happened to to fiat denominated assets in the face of gold. Now, some of you have probably seen a chart similar to this through the years, but we're happy to say this is updated through year end 2025. So I don't think almost anyone has seen a chart like this. And we have added in here the Chinese currency, which we have not seen done before. So what this chart is showing is going back 100 years, if we did what's called indexing. So we capture as a snapshot, what is the value of a currency and gold 100 years ago, and the currencies we're looking at are the US dollar, the British pound sterling, which was the prior sole reserve currency, the Deutsche Mark, which evolved into the euro in 99, the Japanese yen, the Swiss franc, which many people still love so much today, and the Chinese currency. So what you see on the left side is everything starts out at 100, right around this steady gold line. That gold line is the price of gold, unchanged. And what you see is the value of each of these currencies relative to gold over time. Now, remember, take it back a minute ago, 35% of investment advisory wealth, where they're telling families how to store their money, is in dollar-denominated assets, fixed income, exactly the type of asset that's being captured in this chart and its loss of purchasing power. So what you see is almost immediately they begin failing against gold. You see the Deutsche Mark chart where it goes almost directly into free fall as hyperinflation breaks out. Other points to look at 1971 and how, again, we saw a very accelerated downdraft in the value of currencies relative to gold. Why 71? Interesting. That was when the US finally broke the last vestiges of our constitutional mandate, tying gold and the dollar together. And then you can hardly even see it here on this chart, is basically what we're witnessing is all the currencies essentially go to zero relative to gold. But if we did blow this up from 2023 on, you'd see an even further acceleration down, because as the United States weaponized the dollar, confiscated Russia's dollars, you saw nations recognize it is a political liability to hold dollars rather than gold, and they have begun allocating more aggressively to gold. So this is data. Tell me, your financial advisors, you don't want their opinion, you want data. Here's the data that is almost impossible to fathom how financial advisors don't understand this chart. Currency after currency implodes relative to the gold currency. And yet today, Americans have been told not to own it, and that manifests in their 0% allocations. Moving forward, the next piece that we want to show you is an issue, the bond problem. So why did Merrill Lynch tell the world investors don't want to own bonds? They want to own anything but bonds. And why is this also echoing from other large investment advisory firms in America? This shows you where we stand today. 4.95% is the current yield on bonds. Let's just call it 5%. At the peak in American history, bonds yielded 15%. What was happening when bonds were yielding 15%? Inflation was around 15%. Mortgages were touching 20%. Now, at 5%, it may feel like yields are really high because we're coming from a generational low in COVID where yields were less than 1%. Remember, you didn't get paid anything for having your money in a CD or a checking account. It was literally 1% or less. So here we are at 5%. People think, oh, wow, inflation's broken out. But no, we are still below average in 2/3 of the history of modern American finance. I mean, 2/3 of the time, yields have been above 5%. So, forgetting for a minute the gravitational pull that debt is going to have on pulling yields higher, let's just think about what this is saying. 2/3 of the time, yields are above here. So yields statistically are probably going higher. Now, what happens if they just go a little higher? Let's say instead of yields being at 4.95%, they go to the first line of this table and they rise to 5.95%, just 1%. This is looking at a bond portfolio where the average duration is 17 to 18 years, not even a 30-year bond. The longer the bond, the worse the situation gets. But this is conceptually saying we have a bond fund. The average duration here is 17 years. A 1% rise in yields leads to a 15% decrease in the value of the bond portfolio. Now, Wall Street has labeled bonds as safe assets. You think about these funds that are called lifestyle funds that dominate retirement portfolios, that dominate 401ks. What are they loaded with? Well, the older you are, the more bonds you have because someone told them that bonds are always safe. That works out fine if you were in a generational move lower in bonds, which is what we were through COVID. But as we wrote in 2022, we believe we have had a major turn, a generational turn, and that we are going to be fighting inflation as a problem and higher yields, higher rates for years to come. So what if we move more than just 1% above here? Because recognize, we're going to talk about later, we are breaking through multi-year highs in yields right now. What if we were to move to 6.95%? That's a 20% loss in a bond portfolio. And how about if we get back to the old high? That's an 82% loss in the value of your bonds. Does that sound like a safe investment to you? Now, Wall Street's going to say, oh, phooey, inflation's 15% in that study. We're never going to 15% again, to which I would say, really? Really? Let's leave opinions aside, Wall Street. Show me the data. Show me when a country can't pay its debts where inflation didn't get through 15%. So again, we can't guarantee you anything. This is our opinion. It's not advice, it's our opinion. But as we look at history, we think the probabilities are very high that this inflation issue is going to continue to grind at financial valuations, that we are going to see inflation much higher than what was expected. And we would submit to you to question yourself, all right, 15% was the prior peak, but when we peaked out, America had a balance sheet that could endure debt. Now, we don't. What if we go above 15% inflation? I'm not rooting for it. I'm telling you, as an American, I don't want it. But I am saying to you, I believe it is prudent, given that history so overwhelmingly says when you can't pay your debts, that nation's inflation rate is going to go through 15%. So what if it happens? That is the bond problem. That is why Merrill Lynch is out there with these sound bites saying you want to own anything but bonds. But when the rubber meets the road, their clients are not positioned according to their talking points. Now, we also have an issue with stocks in this environment. So this is a chart that we were so pleased to present to everyone in 2022 that we think people still don't understand. Every day you hear on the news, inflation is bad for gold, inflation is great for stocks. All right, Wall Street, again, let's put our opinions to the side and let's look at the data. And this is what you want to do for your family's capital, because people, I'm afraid we're running out of runway here and there could be issues ahead. This is looking at what happens to the valuation of stocks with inflation. The y-axis, the vertical axis, shows the earnings per share of the market. The PE, right? The PE, the price to earnings per share of the market. The horizontal axis, called the x-axis, shows 10-year US Treasury bonds as a proxy for inflation. On the left side, you see in COVID, when rates were at 1%, the PE is actually off the charts here. For a brief time, the S&P traded around 50 times earnings. when yields were so low, when inflation was essentially zero, when people thought the world's going to shut down forever, we're never going to have a need for any commodities, anything. All we want is just a little yield. When that happened, stock market traded almost 50 times earnings. Now, what you see is going back when yields were higher, when inflation was higher. Let's see, we just go to the 10% level. The S&P multiple was 15. To get from where we are today, 20 some times forward earnings to 15 is a severe hit to the stock market. And again, that's only a 10% inflation. We saw in 1980, the stock market traded at a single digit 8 times multiple when inflation was high. So Houston, we have a problem with financial assets called stocks too. If inflation is going to be problematic, it is going to weigh on the value of these companies. Why? Because a stock, like a bond, is simple. Everyone, it is simple. The valuation of these assets is simply what is all the cash flow that's going to come off of this company or come off of the bond worth today? Well, if today I can give you $1 million, it's worth $1 million. If I say to you, I'm going to give you another $1 million in a year, how much would you pay me for that? If I'm going to give you $1 million a year, what would you pay me today? You'd pay me less than $1 million because you know that it's going to be worth a little less with inflation a year out. Well, what if inflation rears its head? What if inflation is significant? Then that $1 million worth a whole lot less, right? That's the concept. It's that simple, people. And yet Wall Street, perhaps because they spent billions of dollars building out this infrastructure to sell people stocks and sell people bonds, could that be the reason? Wall Street's pushing stocks. There are problems with valuations. We are seeing today, as we'll show you in these future slides here. Go ahead, next slide, please, control room. There are incremental issues. Now, what we're showing you here is it's not just us telling you this. This is a study looking at Berkshire Hathaway, Warren Buffett's firm. I'm very aware that he is probably the lone significant investor who has not been a gold bull. And someday I think it'll come out that he was pressured not to be. But look at what he did. When he raised cash, he was raising cash because he was saying the valuations of the market are not attractive. He wanted to be defensive. So why the soundbite is you want to be always in the market, always be in the market. What did the smart money do? Buffett raised cash because he knew the drawdowns, the market sell-off when stocks and financial assets are really overvalued could be intense. So what did he do? In the dot-com bubble, he built massive amount of cash here. And you see what happened in the right side. The NASDAQ was down almost 80%. And then he stepped in and he bought stocks when they were lower. 05 to 07, built cash. Market was down materially. What did he do? Then he stepped in and bought stocks. Fast forward to today, they have never had a cash hoard like they do today. So Warren Buffett, the champion, Captain America of the stock market, saying, be in the market. He's had a great record, but he has never had more cash. Why? His wallet is telling you that he is saying these valuations are not attractive and that people will not do well. Record cash. He now holds more cash than Amazon, Alphabet, Microsoft combined. So does that dovetail well with the way investment advisory firms have families positioned today? The masses, the hordes, the cattle, are families being told own tons of stocks. By numerous metrics, we are at record highs in American stock ownership. Contrast that. We've seen the central bank selling dollar assets. We'll talk about that more later. And we're seeing brilliant investors like Berkshire raising record cash because they want to step aside from what they think is going to be a severe market pullback. Now, here's another look at this. Right now, the S&P is at about 22 times forward earnings. This is rare air. We've only been at this valuation twice so far. We've only been this expensive. The market's only paid so much for cash earnings 2 times before. And the outcome has been that people who were invested at that moment in time, when valuations were so rich, didn't do very well in the future. The historical base rate is -2 to +2%. If I said to you, hey, great news on your 50% allocation to stocks, the probability suggests you're going to earn 2% a year for the next decade. Are you excited about 2% a year? You know that doesn't cover the cost of inflation. And what about the risks you're taking in stocks? Is that worth it? There's a model called CAPE that tries to adjust for the PE. That suggests you can expect to earn a 5% loss in equities in the stock market per year moving forward for the next 10 years based on valuations today. Goldman talking about a 3% approximate return. Bank of America, Merrill, again, the ones who said don't own anything but bonds, 1% to 2%. So just think about it. If you were to buy, let's say the homes in your neighborhood had been selling for $500,000 on average for 5 years, and you step in, you buy a home today for $3 million, should you have conviction that you're going to make a lot of money on that? Or do you think it's more likely that your home's the outlier and that you're going to have to take a loss to get back towards the average valuation? That's a comparison that is what these statistics are showing. When you pay so much for earnings, probability suggests you're not going to do well on the sale. So that also should be a contributing factor to say, maybe I should reduce for yet another reason here, right? We're giving you all these different reasons to just reduce my stock market exposure and maybe have a little bit of something that thrives in these drawdowns. Next slide, please, control room. Here, we want to look at the headline that broke last week. We talked about inflation being problematic. People say, oh, ridiculous. You're just worrywarts. There's not going to be a problem with inflation. Well, what does the market say, right? Let's again separate opinion, look at the data. The US 30-year bond just hit the highest yield, which means the lowest price, right? Trading at its worst price since 2007. Why? Some bond investors are starting to worry about inflation. Will these 5% yields cover the cost of inflation? Maybe not. Now, if rising yields mean falling bond prices, how exposed is the average investor without realizing it? Great question that we received. And we would say, we don't think investors have had this explained to them by their advisory firms at all, right? We just showed you if, it's a big if, but just conceptually, if we got back to prior inflationary peaks, it would mean today's bonds would lose 80% of their value. That should at least be on the table for conversation and discussion. And then your advisor can poo-poo it, but don't sweep it under the carpet. Because again, the data says we're heading back to that area before this is all over in this cycle. Be aware of it. Next slide, please. All right. Let's talk about what we're seeing again as the rubber meets the road. Blue Owl is a private credit fund. Their billionaire just went and sold his remaining stake in the NFL franchise Washington Commanders. That's the kind of thing smart money does, either when they think risk assets are maxing out in price, or perhaps he actually needs some cash. Why? Well, perhaps private credit isn't what it was supposed to be when you think about the liquidity that it provides. Perhaps he needs cash. He's a billionaire. Perhaps he needs cash. Well, how about another well-known name, Harvard University, $50 billion endowment, $50 billion. You think their investment team makes a lot of money? Think any of their top investment guys aren't making 7 figures? By one metric, Goldman noted 83% of Harvard's $50 billion is inaccessible in private equity and private credit. They have it locked up. They've bought this story, hook, line, and sinker, thinking that private credit, private equity are just the future. And they have paid through the nose for it. And now they can't access it. And yet they need cash. So Harvard had to go out and sell almost $1 billion of assets. One observer commented, and we think he's right on the mark. This model where Harvard and Yale, and so many pensions people, so many 401, so many of the big plans have so much of their investor wealth in private equity, private credit. It only works in the environment like we saw when the credit bubble was expanding and when government's buying tons of debt to suppress yields and people are all into risk. This to us says, again, we are still, in our opinion, very early in seeing these assets mark to market in reality. Because remember, when private equity and private credit managers admit that the assets they have invested their clients in aren't worth as much as they have been saying, it cuts at their fees. It cuts at their bonuses. And so we think they have been very slow in doing this. And contrary to what the management teams of companies like Blackstone are saying from their perches on the top of Wall Street towers, we think this is going to be a problem ahead. Now, hey, that's our opinion. We hope we're wrong. But again, our unchanging message to you is Americans are invested like there's no chance that there's going to be problems ahead. And yet the data is telling us we've got real issues. And we're saying to you, you want some hedge in what has worked well historically when credit bubbles have collapsed. Next slide, please, studio. So we are very happy to see, again, Goldman Sachs, one of Wall Street's most admired firms, has done a 180-degree turn. And we're very happy to have them now agreeing with us that central banks are not done. You've heard all year, last year, central banks have bought gold. That's why gold price has risen. They're about done. Now we hear, oh, they're going to sell all their gold because they got to finance the war effort. They got to finance how to buy oil. Central banks are going to sell their gold. We got this major headwind coming. That's the narrative that Wall Street has been telling. And then gee whiz. Looks like Goldman Sachs is saying maybe not. Maybe these central banks, and remember, the central banks are the entities that issue our currencies, the dollars, the yen, the euro. Maybe they see the mistakes that they've made. Maybe they don't want to have the same investments as they want you to have because they're voting with their wallets. They don't. The most informed political entities in the world, these central banks, are voting with their wallets and they are buying gold. They are buying gold. The last reported month that we saw, tremendous increase by China. Again, they've been buyers for over a year and a half now. The last reported month that we saw, China bought a record amount of silver. So these banks are not traders. History suggests their focus is that they want long-term protection and they're finding it in gold. Next slide, please, studio.
Drew, can you answer the question at the bottom of that slide real quick?
Thank you so much. Are central banks buying gold as a short-term trade or as long-term protection? And we would say if you look at the histories of these central banks, they're not traders. These are long cycles. It was from 1980 until 2008. The central banks were sellers of their gold. It was literally a generational trade. They've just begun buying in 2008. from modern era lows in terms of how little gold they had as central banks. We don't think we're anywhere near the top. We think they are buying this for protection through this next financial paradigm shift. Now, in this table, we want to talk with you about, well, what could happen? In the last inflationary peak, 1980, again, we want to think forward, right? If inflation is still coming, then it's not the behavior up to this point that matters. It's what happens as inflation crescendos, right? In 1980, central banks had 80% of their financial reserves in gold, 80%. In 08, that troughed at 9. Today, they're about 22%. So that means the central banks have to buy, with them having about 38 trillion in gold, 38 trillion in value across all the central bank assets, a little under 6 trillion in gold. The central banks have to buy $15 trillion more of gold if, it's not a given, but just conceptually think about this, if central banks perceive a high inflationary environment and they want to get back to the type of gold allocations they had in the past, 80%. So again, if central banks wanted to have 80% of the reserves in gold, which I would submit to you is a higher probability than Wall Street's thinking, because these central banks are seeing the fiat currencies that their policies have wrecked. They're seeing value getting eviscerated in those fiat currencies. And then what else are they going to turn to? What other currency can the central banks own that will protect their wealth? They know history. I think we're going to see again like a gravitational pull of a star, central banks' allocations of gold increasing. If they get to the prior peak of 80%, that would be $15 trillion of gold. Now, there's a lot of different ways to think about how that could happen. Price only, you could see the price of gold go to 17,000 an ounce. I mean, they don't have to conceptually buy more. They can just hold it. And if when gold gets to 17,000 an ounce, we would get there. But realize this, if you look at it from the other perspective, okay, let's say the central banks want to get there and they want to buy gold. $15 trillion of gold at today's prices is almost 100,000 tons. People, that is almost 30 years of gold mine supply. Meaning, if for the next 30 years, all the gold miners in the world said, we're going to give every ounce we pull out of the ground to the central banks to accommodate them so they can get to prior levels of gold holdings, it would take 30 years of mining at today's prices to accomplish that. Do you realize how crazy that is? Because the rest of the world's going to want gold. What if America wakes up and people say, goodness gracious, my advisory firms had me allocated completely incorrectly. I, as an American, have 0% allocation to gold. I may want something like inflation history tells me I want. So do you think the central banks are going to be able to buy all the gold for the next 30 years? Of course not. So just directionally think about what that is saying. If central banks continue to buy gold, in our opinion, they will. Because if we can see the next chart, please, studio. Well, you know what? Actually, we may have cut that out. Just so you know, I apologize. Sorry. Just so you know, where central banks are relative to their gold assets, 22%, just to give you a couple of other data points here. When communism fell, central banks had about a 30% allocation to gold. That's 50%, call it, above where we are today. That's material purchasing just in and of itself. And we would submit to you that when the Berlin Wall fell, when communism ended, the world had been seeing this coming. So the risk premiums were falling, meaning it was becoming more advantageous to own financial assets. We're in the opposite seat today. Risk premium are rising. Globalization is breaking apart. The risk premium investors will demand on equities will rise. So we are early, in our opinion, in getting back to a more steady state level of physical gold ownership by these banks. Wall Street is making the mistake of looking in the rear view mirror, seeing we're coming from an all-time low, and thinking that where we are now is exaggerated. Thank you. Next slide, please, studio. So here, we just want to summarize a couple of ideas for you on other recent headlines. If you didn't see it, you've probably been hearing about it. Elon Musk, SpaceX, we're even getting calls from people saying, how can I get in on this IPO? What's called their S1, which is what a company files with the Securities and Exchange Commission before they do their IPO, finally was submitted just yesterday. Now, to frame how rich this is, because they're talking about the first IPO ever north of the $1 trillion mark, right? Musk has everybody so excited. So if you look at their revenues in the first quarter of this year, again, they just filed this yesterday, they are talking about a valuation of 100 times revenues, not 100 times earnings, 100 times revenues. Wow. How do you do that? Well, it's got to be incredible growth, right? Incredible growth. But they're showing that they've only grown at 15%. 15%. So I want to tell you guys a little story because I think this is ringing the bell from the dot-com crisis. About 3 months ago, we made the comparison. We told you of our experience when we were at Lehman Brothers as employees, and they said you can no longer take your money out. That was the bell ringer that my colleagues and I should have seen. Get your money out. They're trying to keep it in. Well, I want to go back to the prior bubble. I had the great blessing of working at the Swiss firm Credit Suisse, First Boston, in the late 90s. It was a wonderful era in financial history. The internet was real and it was coming on. And you could see what we're doing today, that so much was going to be dominated by the internet, that value was being created by these visionaries, that these business models, while some of them were complete junk, right? And that was what crashed the hardest. Some of them were real. Well, I would submit to you that the apex of internet fever happened in early 2000 when this company from Maryland called Corvus had its IPO. On day one, the Corvus IPO traded at $100. Now, back then, $100 was really rare territory, more so than it is today. $100. It became the first company ever to raise $1 billion without having any revenues. Why? Because the street believed optical internet was worth it. The hype hit a crescendo. If we could forward for one moment, please, just about this next slide. So here's the chart of what happened to Corvus. Day one hits $100. A few months later, they came out and they said, we've lost a whole lot more money than we thought we were going to. This really doesn't have the demand that we thought it did conceptually, this idea that was way out there, optical internet. Corvus lost 99% of its value. The hottest IPO in the internet era. I am submitting to you, I think we're hearing the bell ringing here with SpaceX. And this is potentially near the top of the AI bubble, that these numbers are crazy, crazy. And the path to profitability for them, like for many of these private equity and private credit firms, like for many of these real estate projects, is just highly unlikely. So I would be saying to you, I believe this is yet another sign that we are so close to the top, and that I would be encouraging families across the country to get more defensive. If we go back to the summary slide there, also want to highlight for you, just this week came out that the nation of Turkey sold all of its US treasuries, all of them, right? Remember, a few years ago, the mantra being taught at Harvard, Stanford, Yale, Wharton, all these great business schools was that the risk-free asset was the US T-bill, the US dollar, right? The risk-free asset. That has been the foundation of Western finance. That is the idea that your investment advisory firms have built your portfolio on, and it has been obliterated. The dollar, the T-bill, is not risk-free. It may be, as Jim Grant eloquently said, it's return-free, full of risk, meaning it gets you nothing but risk. So here we have the nation of Turkey stepping in. They have sold all the treasury holdings. expressing similar concerns to what we talked about on our prior broadcast. We had billionaire Jeff Gundlach, who runs almost $100 billion of fixed income money, literally sold US Treasuries, expressing his concern that the US may not be able to pay its interest expense. That will be a financial wipeout for Wall Street if that comes to play. Now, we're not saying that's going to happen. It seems to us it's more likely they're just going to keep printing money as long as they can, like we've seen in the past. But again, we are passing the point where the street's just been able to accept that. Treasury yields at highs we haven't seen since 2007. People are pushing back. A major data point here, an entire nation is saying, get me out of the bonds that Wall Street has trillions of dollars of American families invested in. Wall Street continues to say, and you're probably seeing this yourself, headline after headline, inflation's rising. That's great for stocks. That's terrible for gold. Why do they say that's bad for gold? Because they say when inflation rises, interest rates rise. So these very short-term, and I would say inexperienced traders say, well, the cost of carry, what they call the cost of carry, the lost opportunity by holding gold versus a treasury that's yielding 5% is greater than when the treasury is yielding 4%. It's nonsense. It is nonsense. If your advisor tells you that, say, show me the data. Show me how treasuries did in the last inflationary cycle from 1970 to 1980. They were a bloodbath. That's why Turkey is selling. That's why Jeff Gundlach is selling. They know. That's why Merrill Lynch's CIO is saying anything but bonds. Inflation is a bloodbath for bonds. It's bad for equities. And you look at the charts from the 70s, gold was up massively. Inflation is good for gold historically. No guarantees, right? Gold doesn't have any guarantees, but it has these probabilities that we would submit warrant having allocations far greater than 0%. It's come out this week. Bitcoin is more dependent than I think anyone realized on one firm's buying. Michael Saylor. Look up his history, people. What happened to his firm in 1999? He was around in the dot-com bubble. His stock was at about $300. Where did it go, people? Look into that. About $1, $300 to about $1. And here he is back, champion, hero of Wall Street. He has been buying Bitcoin, and his buying has amounted for more than what has been minted, meaning, as you know, Bitcoin is mined on these computer systems. He's bought more than what has been mined recently, and his purchases may have been 70%. Meanwhile, even his own internal executives are admitting they may have to sell Bitcoin. We have been blessed to work with many big early Bitcoin investors, and one of the most noteworthy admissions from them is that all of the use cases for Bitcoin are failing. So you may want to own some Bitcoin. We would say to you the same thing we've said for years. If you own it, just make sure you have an appropriate allocation to it so that because it is a risky asset, it doesn't have a track record of preserving wealth for centuries. Make sure you size your allocation so that if it is crushed, you're not crushed. Last headline we want to point out. Again, people, there's just so much news flow coming out that is so supportive of what we're telling you. So the co-founder of what was called the Quantum Fund, one of the most successful funds in years gone by, is Jim Rogers. He just admitted, contrary to what investment advisory firms are telling American families, this astute investor has sold all of his US stocks, all of them. He is saying the correction is likely coming soon. What is he buying? Gold. He is buying gold. Okay, so how do we put all this together in a summary for you? We would say, oh, actually, let me just show you one more slide. We don't think anybody else has presented this. So this is a chart showing the blue line is the gold rally up till today. This is on what's called a log scale. So to get both charts on the same page. The yellow line is what happened to gold in Weimar, the German Republic, when Germany couldn't pay its debts. Kind of similar to where we are now. So what you see is that although it feels like gold has run so far, up to $4,700 an ounce today, it really is kind of flat in comparison. And what you see is in Weimar, when they crossed 5,000 units of their currency, gold became 5,000 units. That was when the acceleration in gold really took off as their debts became more and more unpayable. The dawning arose among investors. They needed gold, and it catapulted the metal higher. So, no guarantees, but we think it's very interesting how similar these charts have been. We want to also just say to you, because what we see is so many Americans don't have disposable cash to buy physical gold, but they understand and they want to have diversification in their portfolios because they begin to understand, as we've demonstrated with you in the past with our charts and our studies, if you own 100 stocks, you're really not any more diversified than if you own 10. The way you really diversify a portfolio is to have what's called an uncorrelated asset. And gold is one of the few assets that is uncorrelated to stocks and bonds. That's in and of itself a great reason to own it. And then gold also offers you diversification outside the financial system. The financial system with quadrillions in derivatives, how valuable is it to have that diversification? We receive recognition for having the best performing physical gold retirement platform by an independent custodian. That was for our IRAs. Literally 10 basis points a year for many investors. That includes storage, insurance, and auditing. We now have more conviction that what we told you before is conservative. We had said to you, we think we have innovated a way so that investors can allocate a portion of their 401k plans with their current employers today to physical gold without quitting their job, without quitting their 401k plan, and still continuing to receive the matches from the employer that are so valuable. Without quitting those things, we believe now over 85% of the 401ks out there, from what we have seen from the plan documents coming in, are eligible. So if you work at a company and you have a lot of your wealth in your 401k plan, you want to go to your employer and say, I personally would like to have some of we encourage you. Let's just assume for a minute that as you think about this, you think, yes, it makes sense to have some of your wealth in physical gold. You can go to your employer and say, I personally would like to have some of my 401k in gold. Here's a company, St. Joseph Partners, that can help you as the employer and me as the employee accomplish this diversification. Even if the employer doesn't care about you, right? And I know there's tons of cynicism out there is appropriate with all the offshoring of our jobs. Even if the employer doesn't care at all about his employees, he should want to do this to cover his own rear end. Because I would welcome being an expert witness for an attorney who is representing employees in a 401k plan and saying we need diversification. So know that we have this, reach out to us. We think they are going to realize, employers are going to realize it is in your interests for you to have physical gold in your 401k plan, and it's in their interest to protect themselves. All right, so summing all of these points up, what would be the takeaway message we would say to you? We think the headlines that are coming out are suggesting our debts are going to be problematic. Inflation is going to be problematic. Those are going to weigh on financial assets such as stocks and bonds, and they're going to accentuate, that reality is going to accentuate the benefit of having uncorrelated physical gold. And that today's allocations of Americans at 0%, really, advisory firms couldn't do a worse service to their clients with this setup. We submit to you, and we'll gladly detail with anyone that the math is clear. You want approximately 20 to 25% of your wealth in physical gold and physical silver to optimize your portfolio from a diversification and risk management perspective. Now, I want to say to you on this last point that we just said, that you want that. We hear story after story of families going to their advisors and being told it's stupid. Literally, yesterday, a very successful client went on a glorious boondoggle with the management teams of mining companies, with investment bankers, a 5-day trip. And at the end of that trip, the client's significant other said, for the first time in her life, now I understand why gold is so unique and why we want some in a portfolio. That woman, the day she returned home, went into her financial advisory firm after spending 5 days with the greatest minds in the mining industry. This salesperson, who is employee number 30,000 at her investment advisory company, talked her out of buying $1 worth of gold. We had another employee, another client literally today tell us of a similar story, an entrepreneur worth tens of millions. His financial advisor talked him out of buying anything other than 20 ounces of silver. So we empathize with that. So know that that is probably what's going to happen when you go to speak to your advisor. Everybody says they're good people. Of course, they're good people, but they don't understand the importance of allocating away. And I want to tell you one last story on a personal front about how difficult it is to see this. When I was at Lehman Brothers, I should have seen, I had all the training at Wharton. I had all the lettered degrees as a professional. If anyone should have known holding Lehman Brothers was a dangerous move and that I should have gotten my wealth out of Lehman Brothers and into an uncorrelated asset like gold, it should have been me. And so when I went to make that case to our management team, they said, oh, you sissy, go back to your desk, start working. The company's been around 100 years, nothing's going to happen to you. And they talked me out of it. They talked me out of it. So I empathize with you. The smart minds, the relationships that you have with these financial advisors, they're going to talk you out of it. History's clear. Again, these record allocations to equities that we have today, the record margin debt, this is what we saw on smaller scales each time credit bubbles burst in the past. Financial advisory firms do not position you for the future. They are in place to give you what's selling. You've got to be the decision maker. You've got to go to them and say, good, I'm hoping for the best. I want X percent that you conclude is the best out of your account now. And I want it in physical gold and silver as diversification. And then if they feel that they're losing control of you completely, they're going to try and sell you on financial gold that stays with them too. Realize the central banks know they can call Goldman Sachs, they can call Morgan Stanley, and they can say, sell me a GLD, which is a financial gold like your advisor is going to say. Central banks are saying, no, we don't want any of that. We want the physical in our own country, in our own possession. And that's what you want to diversify and protect your family. So in conclusion, this has really all been about gold, right? Our broadcast is God and gold. I want to end by sharing one story with you on the spiritual front. So we have a lot of exposure, more so recently, with people from China coming to us. I want to share a story that's just amazing to me. Mao Zedong killed, by some estimates, 70 million people in his own country. 70 million. Dwarfs Adolf Hitler. Do you know what he essentially suggested with his policies that were uniquely directed to one organization? Do you know what he said was public enemy number one to China? This is, again, a man who killed 70 million people. Who do you think he would consider public enemy one? He said it was the Legion of Mary, thought of as an old lady society that just gets together and prays once in a while. People, Think about this. The central banks are revealing by their actions, they control the currencies, what to do. They're buying gold, even though they're telling you it doesn't matter. And I want to submit to you, this woman, Mary, who was given to us as a spiritual mother, and people, this is going to help your investments. I believe this is going to help you with your investment decisions. The only eyewitness account we have of Jesus' death, the last words Jesus spoke to humanity was, behold your mother, this woman. What does her spiritual resume look like? Off the charts. In the year 0 AD, she shows up. What happens? The Holy Spirit proposes matrimony to her. God himself wanted to marry her. She says yes. She becomes God's mother. We then see her a few years later sway the outcome of heaven, unlike anyone else in the Gospels, inspiring Jesus to do a miracle, turning water into wine. What a great miracle. Wanted the party to go on. Year 33 AD on her resume. What she does makes Abraham's accomplishments look like child's play. Abraham, the father of all nations. Why? Because he was willing to let Isaac be sacrificed. When she showed up on Good Friday, she trounced. I shouldn't say it that way. The greatness of her actions superseded Abraham. And what did Jesus say? Behold your mother. She's come through time and time again. She has been credited for wars being won against all odds. When she showed up to George Washington in the United States of America, was at its lows in 1777. After she appeared to Washington, America never lost another battle. She showed up in 1981 behind the Iron Curtain. Years later, the Iron Curtain fell. I want to submit to you one of the great psyops of our day has been our fellow Christians saying, there's no room for Mary. I want to encourage you, ask her to pray alongside of you and say to her spouse, Holy Spirit, help me to make the best decisions for my investments, to know what's true. Help me, Holy Spirit, to make the best decisions for my families, for my family, for everything that's important to you. And I think you're going to see Jesus meant what he said. And it was an incredible gift when he said, behold your mother. There's a sweetness, another element to it. So this month is dedicated to her. I want to leave you with that, as I think it'll be a great blessing to you and your family to experience the richness of how she complements a relationship with King Jesus. Thank you for dialing in.
Hey, Drew, we have one question from
Please.
John. He said, are gold and silver ETFs a bad investment as well? And what about a mining fund?
Okay. So a little bit like what we were talking a minute ago there. So an ETF is an exchange traded fund. It's a financial asset. It functions like a stock. So there are ETFs that are supposed to replicate the benefits of owning physical gold. The biggest ones are the GLD, the ticker for the gold ETF, and the SLV, replicating the silver ETF. So the idea the financial advisory firms present is it's just as good for you to own these ETFs. You don't have to worry about anything. You can get in and out of them. There's no cost, et cetera, right? But again, what do we see the most informed players doing? The central banks are saying, we don't want the ETFs. We want the physical. Why? Because I think they know that if you have an ETF, first of all, in almost all cases, you don't own gold. You have a claim on it. That's a fancy word for a derivative. It's a derivative exposure. And you can't, in most cases, take delivery of that. I know some people say, hey, well, there are some good ones that you can. You're right. But people recognize even those ETFs are not set up for you to take delivery. There are significant costs from any ETF to take delivery, to get it into this country, to get it through customs, to get it fabricated, because they're not being held in the ETF structure for John Smith to take his gold. They're being held in the cheapest way possible, usually what's called a standard bar, right? Where it could be literally 100 ounces of gold. Well, they're not going to sawdust that off. They got it fabricated for you. So I would say that the only time to have something like an ETF that replicates the physical gold is if you're just going to trade it. Because we're not telling people buy your gold for a few weeks. We're saying you want this as the cornerstone of your portfolio to plan on holding until this financial paradigm has transitioned. So I would only own an ETF like that as a trade, and I would really generally steer you away from it. Now, the gold mining companies should do fabulously well in this cycle. And I would encourage you to look into those gold mining companies. Do your research, but realize this. Again, when you think about that pie chart where we showed how assets are carved up, when you own a gold mining company, it's an equity, it's a stock, meaning it could do great, but it has all the risks of stocks. If they change taxation on stocks, that'll impact your miners. Miners can't move from nation to nation, right? Like if you have a gold mine that you've developed in Tanzania, and all of a sudden the government comes in and says, the people are really upset, they're restless, they're rioting. Well, we're going to change our agreement with you, Mr. Gold Mine. We are now going to double the taxation that we agreed to. Even though we have 1,000-page document saying we would never do it, push comes to shove, we're going to do it. The gold mine is not going to say, I'm just going to airlift the mine out of here, right? They are totally beholden to that government's whimsical change based on really their fiscal irresponsibility, which is the rule of thumb among governments. So it can do great, but just mentally be clear. If you have a gold miner, you're positioned in one of the few asset classes within stocks, I should say one of the few industries within stocks that should do great in an inflationary environment, but it's a gold stock. It's not the physical gold that's a currency diversifying your cash, your T-bills, your T-bonds. So to summarize that, own some gold miners, recognize that's part of your equity holdings. We would say you definitely want to own the physical, because again, that's the currency that the central banks are clamoring to. The history says will be what's next in this next stage of our financial history. So thank you so much for joining us. God bless, and God bless America.